Good morning, this is Tim McGowan for the Finance News Network. US equities were mixed in fairly choppy Tuesday trading, closing off their worst levels. The dominant theme remains the strength of the US dollar. As to the why, the answer is the world economy has suffered four linked shocks since 2020. The pandemic, of course, a huge fiscal and monetary expansion in response to a post-pandemic supply crisis in which pent-up and lopsided demand hit supply constraints in industrial inputs and commodities, and of course finally Russia's invasion of Ukraine, which hit energy, particularly for Europe. As a result, investors have faced enhanced uncertainty, strong inflationary pressure in the US, and a need for monetary policy, particularly of that of the Federal Reserve, to play catch-up. The result, the US dollar is king of the castle. Overnight, the Dow Jones Industrial Average fell 0.43%. The S&P 500 fell deeper into a bear market on Tuesday after setting a new 2022 low, and the Nasdaq was up 0.25%. The S&P 500 is now 24% below its record set in January, while the Dow is 21% below its all-time high, and the Nasdaq has fallen more than 33% since hitting a record in November. Plenty of risks around equity markets at the moment. Geopolitical tensions flared overnight with speculation of Russian sabotaging of its Nord Stream pipelines and a fresh nuclear warning from Moscow following the contested Ukraine referendum. All eyes remain on the currency markets. A rally in the British pound fizzled out quickly, with the sterling trading just 0.4% higher against the US dollar. The pound earlier had risen more than 1% against the US dollar in an attempt to rebound from an all-time low set earlier in the week. Stocks initially got a boost after the Chicago Fed Reserve's President Charles Evans signalled some apprehension about the central banks raising rates too quickly to fight inflation. His comments, of course, contrasted with several Fed officials who recently expressed no hesitation in backing the central bank's tough stance against rising prices. Across the sector, a mixed bag overnight, with the US dollar index up 21% this year. The impact is being felt across the S&P 500. Morgan Stanley calculates that every 1% change in the US dollar has a negative 0.5% impact on S&P 500 earnings. The sectors expected to be impacted the hardest include capital goods, software, media and entertainment, materials, energy and tech hardware. As inflation plays out across the globe, the intervention of central banks has been coordinated, with the Fed's tightening ahead of its peers in high-income countries, causing the US dollar to surge. The most important question investors are now asking is whether monetary tightening could go too far. Either way, what is known now is that the central bank's ability to support equity markets and the economy is gone for a while. On the currency front, one Australian dollar has weakened overnight compared to the US dollar, buying 64.34 US cents. The iron ore price is pointing to a 0.8% gain on the futures today. Gold gained 0.2% to $1,636 an ounce, rebounding from a 2.5-year low on Tuesday. Silver was down 0.8%, copper lost 0.3%, and oil added 2.3%. On the futures market today, the SPI futures are pointing to a 0.5% fall on the ASX. This is Tim McGowan for the Finance News Network. Have a great day.